Nobody quits trading because the market is too hard. They quit because the market is nothing like what they were told it would be. And when reality shows up, it doesn't negotiate. Here's what the $497 course told you. Charts have patterns. Patterns repeat. You learn the patterns. You trade the patterns. You make money. Simple, repeatable, scalable. The guy selling the course has a car that suggests it works. The testimonials in the sales page suggest it works. The paper trading account you ran for 3 weeks definitely suggests it works. Here's what the $497 course didn't tell you. Patterns fail. Not sometimes. Constantly. The same setup that worked 4 times in a row will fail the 5th time, with no warning and no explanation and nothing in the chart that told you in advance. This one was different. The market doesn't care that you followed the rules. It doesn't care that you did everything right. It doesn't grade on effort. It doesn't give partial credit. You were right about the direction and wrong about the timing, and it cost you the same as being wrong about the direction. The course also didn't tell you this. The emotional experience of watching your own money disappear in real time is completely different from anything a simulator or a video or a testimonial can prepare you for. On paper, cutting a loss at your stop is simple. You plan the stop. The price hit the stop. You exit. Move on. In real life, at 9:48 a.m., with $340 on the line, the stop feels negotiable. Just give it a minute. It might come back. The thesis is still valid. The setup was right. The market is just being noisy. That pause costs you $340 more than the stop would have. And then you revenge trade the $680 loss and turn it into $1,100 and close the platform and stare at the ceiling and think, what is wrong with me? Nothing is wrong with you. You were just never told that this part existed. The course sold you the strategy. Nobody sold you the psychology because the psychology doesn't have a clean sales page. This is why 99% quit. Not because they couldn't learn the setups, because nobody prepared them for the gap between knowing the rules and following them when it costs something to follow them. The 1% aren't smarter. They just stopped being surprised by that gap and started working on it instead. Section 2. The 3 stages of quitting. Most traders don't quit all at once. They quit in stages. And the stages look so much like progress that by the time the actual quitting happens, it feels like a reasonable decision. Stage 1 is the angry quit. This happens early. 3 months in, maybe 6. The account is down. You've blown through 2 deposits. You're sitting in front of a red screen on a Friday afternoon and something shifts. You close the app. You tell yourself the market is rigged. Market makers, algorithms, the house always wins. You post something on Reddit about how retail traders don't stand a chance. You get 14 upvotes. You feel briefly understood. You're back in 2 weeks. The angry quit never sticks because the anger fades, and underneath the anger is still the original idea. The possibility. The $4,200 screenshot that started this. You can't unsee that. Stage 2 is the smart quit. This is more dangerous because it sounds reasonable. You've been at this for a year. You've done the math. Win rate 48%. Average winner $180. Average loser $310. Expected value negative. You build a spreadsheet. The spreadsheet confirms what the account balance already told you. You write a forum post explaining why you're stepping away to reassess. People call it mature, self-aware. You frame it as a strategic pause. It is a strategic pause. The problem is that most people in stage 2 use the pause to stop, not to fix. They pause. They reflect. They drift toward other things, and 6 months later, the pause is just the end. Stage 3 is the quiet quit. No post, no announcement, no spreadsheet. The platform just stops opening. The alerts stop. The watch list goes stale. Life fills the space. A new job, a relationship, a different hobby. The account sits there with whatever's left in it. A few $100s. A reminder of something that didn't work out. The quiet quit is the most common one, and it's the saddest one because it happens to people who are actually getting better. People who made it through stage 1 and stage 2 and were 12 months away from something real. They just ran out of runway, money, or time, or belief. Sometimes all 3 at once. The 1% go through all 3 stages, sometimes more than once. The difference isn't that they never want to quit. It's that they build something that makes quitting more expensive than continuing. Section 3. What the money is actually testing. Everyone thinks trading is about reading charts. It's not. The chart is just the surface. Underneath the chart is a continuous psychological evaluation that the market runs on you every single session, and the chart is just the medium it uses to deliver the test. Here's what the money is actually testing. It's testing whether you can be wrong without it meaning something about you. Most people can't. Most people are wired from school, from work, from every environment that shaped them to treat being wrong as a failure, a verdict, something to avoid, hide, or argue against. In trading, being wrong is Tuesday. You're wrong on 40% of your trade's minimum, probably more if you're honest. The question isn't whether you'll be wrong. The question is whether being wrong will cost you $100 or $800, depending on how long it takes you to accept it. It's testing whether you can do nothing. This is the hardest one. There is no alert for doing nothing. There is no entry in your journal that says, "Today I identified 4 setups. None of them met my criteria. I did not trade. I closed the platform at 10:30 a.m. That day feels wasted, invisible, boring. But the discipline of doing nothing on a day with no setups is exactly the same discipline you need on the day you're in a losing trade and your hands want to do something. Doing nothing is a skill. Nobody teaches it because it doesn't have a chart pattern. It's testing your relationship with uncertainty. Certain people and traders skew heavily toward this personality type: need to know, need to resolve, need to close the loop. A position that's neither at target nor at stop, just sitting in the middle, moving back and forth, unresolved, can be almost physically uncomfortable for people who need certainty. So they close it early. They take the small winner instead of waiting for the target. They avoid the uncertainty of holding by manufacturing a certain outcome, a small green number, and feeling briefly better. Over a year of trading, that pattern is the difference between a 1.2 to 1 and a 2.5 to 1 average reward to risk. The account feels the difference, even when you don't notice you're doing it. It's testing how you respond to a streak. 3 losing trades in a row. Most traders change something after 3 losses. They widen the stops. They reduce the size. They switch instruments. They add an indicator. They do something, because doing nothing while losing feels like being passive about your own failure. Almost every change made during a losing streak makes things worse, not because the original system was perfect, because you're changing strategy while emotionally compromised, which produces compromised strategy. The 1% are not people who pass these tests easily. They're people who failed them enough times to recognize the moment they're being tested and pause long enough to choose the response instead of just reacting. Section 4. The cost nobody mentions. Everyone talks about the financial cost of learning to trade. Deposits, course fees, loan accounts, evaluation fees. By the time you get to a consistently profitable month, you've probably spent $5,000 to $15,000 getting there, depending on how expensive your mistakes were and how long it took you to stop repeating them. That number is real, and it's significant, and it's the number most people focus on when they do the post-mortem on a failed trading attempt. But it's not the most expensive cost. The most expensive cost is time, not the hours you spent watching charts, the months, the years, the period of your life where trading was the thing you were trying to make work, and so everything else was secondary. The side project that didn't get started, the skill you didn't develop, the career move you didn't make, because you were going to be a full-time trader soon, and it didn't make sense to commit to something else. Most people who quit trading are 28 to 34 years old. They spent 2 to 5 years trying to make it work. 5 years is the difference between entry-level and mid-senior in most careers. 5 years of compounding in an index fund starting at 28 is a number that most 28-year-olds don't calculate because they're busy calculating what their trading account could be worth by 33. This is not an argument against trading. It's an argument for being honest about the full cost before you start. There's another cost too, the relationship cost. It's the most invisible one. The person you live with knows something is wrong before you do. They notice the phone checking during dinner. They notice the mood on Fridays that correlates with the week's P&L in ways you think you're hiding and aren't. They ask questions and get answers that are technically true and emotionally incomplete. They stop asking after a while, not because they stopped caring, because the asking wasn't getting them anywhere real. By the time most traders quit, the relationship has absorbed 12 to 18 months of secondary stress that was never named or addressed. Because the trading psychology videos don't cover that part. They cover discipline and mindset and process. They don't cover what you say to the person in your kitchen who is watching you slowly disappear into a screen. The 1% figure out the full cost early. They build around it. They set rules, not just for the trading, but for the life that the trading lives inside. Hard stops on hours, clear communication, a financial floor. That means the trading outcome doesn't determine the household temperature. It's not romantic. It works. Section 5. The skill nobody talks about. There's a skill that separates the 1% from the 99%, and it's almost never discussed in trading education because it can't be taught in a video, and it can't be demonstrated on a chart, and it doesn't have a name that sounds like a strategy. The skill is accurate self-assessment in real time. Here's what that means. At 10:07 a.m., You are sitting in a trade that is moving against you. Your stop is $180 away. The position is currently down $90. You have two possible internal states. State 1. The setup is still valid. The thesis hasn't changed. This is normal movement within an expected range. You hold to the stop or the target. State 2. You're holding because you don't want to take the loss. The thesis is actually broken. You're in the trade emotionally now, rather than analytically, and every minute you hold is a minute you're hoping, instead of thinking. Both states look identical from the outside. Same position, same screen, same hands, resting on the same desk. The difference is entirely internal. The 1% can tell which state they're in accurately, in real time, under pressure. The 99% can't. Not because they're not smart enough, because they've never built the practice of checking. They've been told to follow the system and trust the process, but nobody told them to check in with themselves while it's happening and ask, am I following the system because the system says to, or am I following the system because it gives me permission to do what I already wanted to do? How do you build this skill? You write it down before it happens, not during. Before the session, you write, today I am likely to feel X in situation Y. Today, if the morning trade loses, I will probably feel the pull to increase size to make it back. I will not do that. I know that feeling is coming. I am naming it in advance so that when it shows up, I recognize it instead of following it. This sounds simple. It's not easy. Doing it every day, before every session, for 6 months, builds a relationship with your own patterns that no indicator and no course and no Discord community can build for you. It's free. It takes 8 minutes. Almost nobody does it. The 1% do it. Not because they read about it somewhere, because they made expensive enough mistakes, often enough, that they needed to build something that actually worked. And this is the thing that actually worked. Section 6. Why most people solve the wrong problem. When a trader is losing consistently, they do one of 3 things. They change the strategy. They add indicators, remove indicators, switch time frames, switch instruments, switch from trend following to mean reversion, back to trend following, add a filter, remove the filter, try a different moving average period. They treat the losing as a signal that the strategy is broken, and so they fix the strategy. Or they find a new teacher, new course, new community, new system. The logic. I've been doing it wrong because I learned it from the wrong person. If I learn from the right person, I'll do it right. The new teacher has different words for the same concepts and the same outcomes for the same reasons. Or they take a break, 2 weeks off, come back fresh, clear head, new month, new start. The break is real and the rest is real, but nothing changed structurally during the break. And so the first trade of the new month is taken by the same person who took the last trade of the last month, just slightly less tired. None of these fix the actual problem, because the actual problem isn't the strategy. It isn't the teacher. It isn't the fatigue. The actual problem, in 80% of losing traders, is execution, not entry execution, post-entry execution. What happens between the moment you're in the trade and the moment you're out of it? That 20-minute window where the position is live and the P&L is moving, and every tick is producing an emotional response that is influencing a decision that the trading plan either covered or didn't. Most trading plans cover the entry in detail. Conditions, confirmation, trigger, 3 paragraphs minimum. The exit gets 1 line. Stop at X, target at Y. What happens if it moves to 60% of target and then reverses? What happens if it gaps through the stop? What happens if the setup looks perfect at entry and then a news event hits and nothing makes sense anymore? Most plans say nothing, so the trader improvises. And improvised exits are where accounts go to die. The fix is not a new strategy. The fix is a surgical look at your last 50 exits, not entries. Exits. Where did you deviate from the plan? When? Under what conditions? What was the account balance that day? What happened on the previous trade? What was the pattern? The pattern is there. It's always there. Most people never look, because looking means accepting that the problem is them, not the system, and accepting that is harder than buying a new course. The 1% look. They always look. Section 7. The actual profile of the 1%. You have a picture in your head of what a profitable trader looks like. Probably male, probably 30s, probably calm, in a specific performative way, probably minimal, dark monitor setup, expensive chair, speaks in measured sentences about discipline and process, posts occasionally, never brags, lets the track record speak. Some of them look like that. Most don't. The actual profile of the 1% is messier and more honest than the archetype. They lost money for longer than they expected, not months, most of them years. The average time from first deposit to first consistently profitable quarter is somewhere between 2 and 4 years, depending on which study you read. and how honest the sample was. 2 to 4 years of negative or break-even performance, while continuing to show up, continuing to adjust, continuing to believe something was buildable, even when the account didn't agree. They failed at something specific, repeatedly, before they fixed it. Not everything. One thing. The same mistake on a loop, until the repetition finally made it visible enough to address. For some, it's the stop. For some, it's the size. For some, it's the Monday morning narrative problem, or the end-of-month scoreboard trading, or the revenge spiral after 2 losses in a row. One specific thing that kept showing up and costing them until the cost was high enough and the pattern was clear enough that they built something to interrupt it. They are not emotionless. That's the biggest myth. The 1% don't trade without feeling anything. They feel everything. The difference is they've built enough structure between the feeling and the button that the feeling doesn't automatically become an action. The feeling shows up. They notice it. They check it against the plan. They decide. That gap between feeling and action is small. Half a second, 2 seconds. It's the most important real estate in trading, and almost nobody talks about it because it's invisible and it can't be charted. They also quit. Some of them several times. Stage 1, Stage 2, Stage 3. They came back, not out of stubbornness, out of the specific kind of obsession that looks like stubbornness from the outside, but from the inside, feels more like unfinished business. They needed to know if they could do it. The needing to know was stronger than the cost of finding out. That's the profile. Messy, patient, expensive, and built on the specific decision to keep looking at the problem honestly until the problem started giving up its answers. Section 8. The one decision that changes everything. There's a moment in every trader's journey where the whole thing pivots. It doesn't feel like a pivot when it happens. It feels like a Tuesday, a boring, slightly frustrating Tuesday where nothing dramatic occurs. But looking back, from wherever you end up, it's the day everything changed. The moment is this. You stop trying to find a better system and you start trying to understand why you can't follow the system you already have. That shift sounds small. It's not small. It's the difference between spending the next 2 years buying courses and the next 2 years building a trader. When you're looking for a better system, the problem is always external. The system, the course, the indicators, the market conditions, the bad fill, the news event, the variable you haven't accounted for yet. If you can find the right system, the right combination of variables, the external world will cooperate and you'll make money. When you start understanding why you can't follow the system you have, the problem becomes internal. Your response to uncertainty, your relationship with being wrong, the specific emotional trigger that fires at $200 down and causes you to do something the plan didn't authorize. These are fixable, not easily, not quickly, but fixable because they're yours. You own them. You can work on them every single day, regardless of what the market does. The traders who find this shift find it different ways. Some find it through therapy. Some find it through trading journals, written honestly enough that the patterns become impossible to ignore. Some find it through a mentor who asks the right question at the right time. Some find it through a loss so significant that the only thing left to do is stop blaming everything outside and look at the one constant in every losing trade. You, not as an indictment, as information. You are the one constant. You are also the one variable you can actually control. And the moment you start treating yourself as a system that can be studied, adjusted, and improved, the same way you treat an entry strategy, everything gets slower and harder and more honest, and eventually, gradually, undeniably better. That's the decision. That's the one. The 99% never make it. Not because they couldn't, because making it requires admitting something uncomfortable. And uncomfortable admissions are hard to make when there's still a course to buy, or an indicator to add, or a Discord community to join that might have the answer. The 1% make it eventually, usually after they've exhausted everything else. The answer was never in the course. It was in the mirror. It was always in the mirror. And the day you actually look, without flinching, without adding a filter, without the comfortable story about systems and market makers and bad luck, is the day the 1% becomes possible. It's a Tuesday. Nothing about it announces itself. You'll recognize it later.